On September 17th, the Federal Reserve Bank cut interest rates in the United States for the first time in 2025. Everyone was hoping this meant lower mortgage rates are coming, except mortgage rates didn't fall. They actually went up after the Fed cut interest rates. And now you have the Wall Street Journal saying that you need to be prepared for mortgage rates to go up even higher, even as the Fed plans to cut interest rates again. And that's why in this video, I'm going to explain the real reason why mortgage rates are not falling and when you can expect mortgage rates to actually fall, so make sure you stick with me to the end of this video. When you go to the bank to get a mortgage, there are two things that your bank is going to look at when they determine what your mortgage rate is going to be. By the way, for my male followers, I drew a mustache. In my native language, Punjabi, we call that a much. For my female followers, I drew a braid. In my native language, Punjabi, we call that a gut. And those two things that your bank looks at are, number one, your personal qualifications, and number two is the 10-year treasury. So your personal qualifications include things like your credit score, the amount of money you're going to put down as your down payment, and of course the loan type that you're going to get. These three things are going to influence the mortgage rate that you get, but the real bigger influence is not your personal qualifications, it's the economic qualifications, which are more specifically the 10-year treasury. See, the way that it works is your bank has access to this money and they want to invest this money and get the best rate of return possible relative to the risk. And so your bank is going to weigh the different investment options. And by investing for your bank, that means lending money. They can lend money to you and vary it based on your credit score, down payment, your loan type. They can lend money to your broke cousin Bunty, who has a bad credit score, who doesn't have money for a down payment, and really is not going to probably pay back that loan. Or they can lend money to the United States government. Now, your broke cousin Bunty is going to be the most risky investment, so if your bank is going to lend money to him, they're going to charge him a very high interest rate. If they're going to lend money to the United States government, well, that's the safest investment because the United States government has the ability to always pay back their bills. How? Because of, number one, raising taxes on you and me, or number two, working with the central bank, the Federal Reserve Bank, to printing money. I'm not talking about the devaluation of the dollar or anything that are associated with that, but the United States government has the ability to pay back those bills, so this is the least risky investment. And this is going to then pay the lowest rate of interest. So naturally, if they're going to lend money to you for your mortgage, you have to pay a higher mortgage rate than what the United States government is paying. Well, anybody, you, me, and well, your bank can lend money to the United States government. And there are many different ways to do that. You can lend your money to the government for 1 year, 10 years, 30 years. But your bank likes to look at the 10-year treasury, which is lending your money to the United States government for 10 years as a benchmark of where to set the 30-year mortgage. So when the 10-year treasury goes up, your mortgage rate goes up. When the 10-year treasury goes down, your mortgage rate also goes down. So when you want to really understand what's going to move the mortgage market, you have to pay attention to the 10-year treasury yield, which means you're probably going to be wondering, Jaspreet, what is going to move the 10-year treasury yield? I'm glad you asked. There are four major factors that are going to influence where that 10-year yield is going to go. And number one is interest rates. Now, when I say interest rates, I'm not talking about the interest rate that your bank is going to charge you when you pay a mortgage or a car loan or a credit card debt. I'm talking about the interest rate set by the Federal Reserve Bank. So let's take this one step back. We have this bank here. This is Chase Bank, Bank of America, Wells Fargo, where you're going to get your banking services done. And then we have the central bank, which is up here, which is called the Federal Reserve Bank. Now, interestingly, they're called the Federal Reserve Bank, but they're actually not a bank because you and I can't go there to deposit money. And they're not a reserve because they're not sitting on any cash reserves, and they're actually not federal. It says so on their website. They're not a part of the federal government. But the Federal Reserve Bank has the ability to monitor our monetary system, meaning they have the ability to cut and raise interest rates, and they have the ability to print money and lend it to the United States government. So when you hear the news like we saw in September that the Federal Reserve Bank is cutting interest rates, what does that exactly mean? When the Federal Reserve Bank cuts interest rates, that means that when banks lend each other money, now they're going to lend each other money at the lower interest rate. This is called the federal funds rate. This is the interest rate set by the Federal Reserve Bank. So this interest rate the banks pay to borrow money from one another is called the federal funds rate. This is set by the Federal Reserve Bank. So when the Fed cuts interest rates, that means banks get to borrow money at a lower rate. how does that impact the 10-year treasury? Because when banks are paying less money to borrow money, they're also going to pay you less money on your savings. So if you have money sitting in a bank, you have money in a high yield savings account, you might have noticed that after the Fed cuts interest rates, you get an email saying, hey, we are cutting interest rates and we're going to pay you less interest on your savings. And so when that happens, you see investors move their money out of banks into, well, number 3, to the United States government. So when you start to see money move out of banks into the United States government because of those low interest rates, now people are buying treasuries. When people start buying more treasuries because there's more money flowing into them, the price of treasuries go up. When the price of these treasuries go up, the government generally doesn't need to incentivize you with as high of interest rates because, well, there's more money flowing in. That's why you may have heard that bond prices and interest rates are inverted. What that means is as bond prices go up, interest rates go down. That's very technical, but all that really means is when you see interest rates go down by the Federal Reserve Bank, more money flows into treasuries, treasury rates generally go down. That's why interest rates have an impact on the treasury market. Now you're going to say, well, Jaspreet, didn't you just say that the Fed cut interest rates, but mortgage rates went up? You're now contradicting yourself. Well, stick with me and you'll see exactly what's going on because it's more than just one factor. There's 4 factors that you want to pay attention to and they all work together hand in hand. So now let's talk about number 2, and this is where I should also remind you that if you are an investor or want to become an investor, I'll put together a brand new investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. I'll also show you the exact system that my team and I use to research investment opportunities before they hit the headlines. It's a completely free masterclass. There's a ton of value in there, and when you register for the masterclass, we're also going to give you access to Market Briefs, which is my newsletter for investors, for free. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do to register is click the link down in the description below. Number 2 is economic growth. And this is going to sound interesting, but when the economy is growing, that actually generally leads to higher treasury rates. And the reason why is because when you see a strong economy, the economy is growing, stock markets are growing, well, people that are putting their money into the United States government treasuries are generally getting lower returns because when you're lending your money to the United States government, that is considered a risk-free investment, no risk, no return. So you're getting the lowest returns when you invest your money in those treasuries. And so that's when investors will generally pull their money out of treasuries because they want to see that growth in the stock market. They want to see that growth in the economy. So as money is leaving treasuries, the price of those treasuries start to fall because everybody's selling. And when treasury prices fall, interest rates generally go up because now the government has to incentivize you with higher interest rates to buy those treasuries. So that's what it means that treasury rates and prices are inverted. When people are selling treasuries because they want stocks, treasury prices go down, interest rates go up. So when you see strong economic growth, that actually pushes mortgage rates higher. Number 3 is investor sentiment. When people are concerned about the dollar, when people are concerned about a recession, when people are concerned about the economy or geopolitics, they want a safe investment. And when they want this safe investment, where do they go? They go to treasuries. So people want this safe investment, they start buying treasuries. Now you already know where I'm going with this. If more money is flowing into treasuries, people are buying, the price of treasuries go up, and where do interest rates go? Interest rates start to go down. Because now as everybody's buying, the government does not need to incentivize you with higher interest rates because money is already flowing in. And as treasury rates go down, mortgage rates go down as well. So when investor sentiment is negative, you start to see treasury rates fall, which also pushes mortgage rates lower as well. But again, it's all in balance. It's in balance with the economic growth, and it's also in balance with interest rates. Because when people are concerned about the economy and interest rates are high, well, those high interest rates prevent the 10-year treasury from going below a certain level because you still have these interest rates higher. And hand in hand with number 3 is number 4, inflation expectations. Notice how I said expectations. When investors are concerned about inflation, that means they're concerned about the value of the dollar. And when you invest in these treasuries, what are you doing? Well, you're just investing your money into these dollars, hoping to get some interest back. Well, if inflation is a problem, you don't want your money getting these small interest rate returns because, well, you could be getting better returns elsewhere. So when people are concerned about inflation, they dump treasuries, they buy things like stocks and real estate and gold and other investments. And when you dump treasuries, treasury prices fall, interest rates go up, mortgage rates also go up. So that's why when you're concerned about inflation, you generally see mortgage rates go up as well. But again, it is a balance of all of these things. When you have these concerns about inflation, but interest rates are slashed down to zero like we saw in 2021, well, that can then push the mortgage rates down even lower because this is outpacing this. So investors worried about inflation, interest rates generally go up. Investors worried about the economy, that generally pushes interest rates down. Investors seeing strong economic growth, that generally pushes interest rates up. And when you have interest rates falling, this treasury rate, mortgage rates also then have downward pressure. All of these four factors come together to ultimately influence supply and demand. Supply and demand for what exactly? Supply and demand for treasuries. That's what is going to influence the mortgage market. And that's why when the Fed cuts interest rates, sometimes you'll see mortgage rates fall, sometimes you'll see mortgage rates rise, because ultimately it's a factor of all these four things. And it's what investors think is going to happen in the future. So now the question is, well, where are mortgage rates going to go for the rest of 2025 and 2026? Well, for the rest of 2025, investors have an idea of what the Federal Reserve Bank wants to do. Maybe they'll cut interest rates one, maybe two more times. But it sounds like the Fed wants to be more aggressive with cutting interest rates come 2026. And when you start to see more aggressive interest rate cuts, that could then outweigh some of the other factors that are happening over here. And those more aggressive interest rate cuts can then be enough fuel to pull mortgage rates lower. Because again, it's the balancing act with these four things that are happening right now. And when you have one thing outweighing the other, well, that can either push mortgage rates higher or lower, but they're all pushing the mortgage market in different directions, which is why you want to pay attention to this and be financially educated. That way, you're not just chasing the hype of what the news says. You actually have the education to understand what is moving the mortgage market and what is moving the economy, because you're going beyond the headlines. So if you want some additional resources, again, I have my investing masterclass for you down in the description. And these are the things that you want to pay attention to over the next 12 months to really get a better understanding of where mortgage rates are going to go. If you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, a family member, a colleague, or a fellow investor. Thank you. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.